Yeah, we start today's market talk. So the core point is be patient. And at the core of any outside success in investing lies the ability to train your mind to patiently pursue challenging goals over a very long period of time and play the infinite game. Don't look at 1 quarter, 2 quarters, etc. If the business is good, play the stock for a longer period, infinite times. Now, why this isn't the time to be a hero? I'll just tell you exactly why I feel like that. Firstly, there is a increased uncertainty has pushed up bond yields across many countries, and the basic thumb rule is if the bond yields go up, the equities come down. Now, in the US, Trump administration is in the process of pushing through the big beautiful tax bill. It will push up US debt over the next decade. That combined with recent downgrade of US credit rating by Moody's has pushed long-term bond yields in the US. Similar story is playing out in Japan where investors are demanding a higher term premium for bonds because of ballooning government debt. Why the premiums are going up? Because of higher inflation, erosion of policy credibility, geopolitics, and fiscal strain on the government budgets. Now, right now in India, the gap between US long-term yields and the our Indian yields is the narrowest in over 20 years. It will have a bearing sometime on capital flows. At some time, global investors will be unable to ignore the juicy yields on US treasuries. If a US 30-year yield is more than 5, it is the safest return in the world. So money will flow out of the EMs into US treasuries. Now, 10% across the board US tariffs may be the new normal. Now, the problem with this is that this kind of a level of tariffs will lead to inflation in US and slowdown in the economy. Recently, Walmart has announced price rises on all basic goods like electronics, toys, etc., and warned that more price hikes will be there in the future. So, what we are likely to see is a kind of supply shock due to tariffs and demand shock due to slowdown. The last time we had seen a combined supply and demand shock all over the world was during the First World War. So, nobody knows how to price this event. Now, the policy uncertainty in the US has reduced the appeal of the US dollar as a safe haven asset, which you can see the US dollar is declining. Higher US yield should be attracting funds into US. If the US yields are higher, the money should flow into the US. But the dollar is weakening because money is moving out of the US due to uncertainty in the US. This is good for foreign investments in Indian equities if the dollar is declining because the return drag from local currency depreciation gets reduced. Now, why RBI has a room to cut rates, maybe even 50 basis points in the next policy, is because our CPI inflation has declined to 3.16 and it's on a declining trend line for next 3-4 months. Growth in core sectors slowed down to 8 months low of 0.5% last month, which is roughly 40% of the corporate earnings. So the growth is slowing. So there is a room for RBI to cut more rates. Now, there is little to celebrate about the Q4 corporate performance. I have undergone through this exercise this time. There's nothing much to talk about here because corporate capex is sluggish, Q4 earnings were muted, and there is no widespread disappointment, but we haven't seen any major earning upgrades also. There is no change in the projected FY26 or FY27 earnings of the Nifty so as to carry out a re-rating of Indian equity. So why this isn't a time to be a hero? Because if you see something fundamentally strong right now and you have some capital available, you can still take positions if the valuations are comfortable. But otherwise, there is no point in getting into stocks which are expensive, right? And let's go sector wise. Private banks have come down from 20% earning growth to around 10 to 15%. The microfinance book is growing, but customer growth is just 3 to 4%. while loan growth is roughly 20%. That suggests that there is over lending which is taking place to the same set of people, and that's why there is a distress in the microfinance sector, which is reflecting in the books of many banks, and especially the mid-size and small-size banks, which for a higher earnings were doing more of a microfinance lending. In addition, what is happening is unsecured personal and auto loans are also becoming risky. Now, credit growth has stayed around 12 to 13% only, even though RBI is more supported on liquidity. Lower rates, moment the RBI cuts interest rates, would impact the NIMs, and NIMs are already at some 3-4 years low, and they are on a declining trend line for most of the banks. Now let's go to FMCG. FMCG is showing 2 to 3% volume growth, which is nothing. I'm talking about volume growth. So any growth which is coming in revenue is coming because there is a price hike which is taking place. Stocks are trading at 40 to 50x earnings, which is not sustainable because these were the traditional benchmarks and some of them are in index. So people have to just keep buying them just to ensure that ETFs, etc., maintain the allocation. But these earnings or these valuations are not sustainable. Now, the pharma, if you see, results were decent, but there is uncertainty on tariffs. Opportunity is definitely there in consumer discretionary stocks, where growth, the only thing which you have to see is if the growth is 15% plus and the operating leverage is playing out, which is helping the profit. Operating leverage plays out if the revenues grow. So at the same base, the company's profits grow exponentially. Growth pocket is in EMS space, definitely. All EMS stocks have done really well. Now coming to IT, AI has disrupted IT. Clients will now demand lower rates for the projects. Hence, margins would be flat or falling. So you can't say that because of AI, the employee cost will go down, so the margins will go up, because clients will also ask for, will give projects at lower margins. Now, defense stocks have rallied, but value is now no longer there. Now, coming to infrastructure, state governments don't have money, which is hurting contractors and construction companies in terms of their payments. And some of the results have not been that good, especially in terms of cash flows. So what is happening is the market cycles have narrowed. Negative events are getting priced in very fast. So you have to be nimble, reassess companies constantly, read about technology, because technology is again a big disruptor. Telecom, aviation, hospitals, select automobiles, and industrials have performed decently. FIs will come back when domestic earning growth confidence improves, when there is a consistency in big earnings. You would be aware that recently Trump signed an order to lower drug prices in US. Hence, it is too early to assess its full impact even on sectors like pharma. Now, coming to FIDI data, it is very simple. Like, see, on 23rd May, the FI short position is still, they just added very little bit of longs. It's still at 54,000 odd. Index futures net negative positions. They added shorts on Nifty, but went bullish on banks. And they were slightly negative on Midcap Nifty. Professionals, they added long positions, while the clients added short positions. Now coming to the FI's data for the month, if you see here, the cash, in terms of cash, on the big days where they have sold, Nifty has also dipped. So they have been selling, the pace of buying has decreased. Hence now the pace of selling is now coming into large numbers, 10,000 crore, 5,000 crore. The net index futures option position, index futures short positions is at around 55,000 crore, which has significantly increased now over the month. So they are trailing slightly negative and now they are booking profits. OI change, if you see here, the days on which they did major addition of short positions, the FIs, those were the days the Nifty also did here, like if you see 1% dip and 1.39% dip. then 1.05% dip and 0.82% dip. So the days they added more short positions, the Nifty had a major dip of around 1%. So you can understand the cause of these dips are basically FI's action. On the days, firstly on 12th May, after we had a big day, so 3.82% rise took place. This was immediately after the ceasefire was announced. And then on 15th May, there was a 1.6% gain. And that day, FIs also added long position. So it's now becoming a more of a FI's correlated move, and nothing else is now making an impact. Now, coming to the US, US markets on Friday closed with losses up to 3%, driven by President Trump's policy decisions. Concerns over tax reform package on US fiscal deficit resulted in a bond sell-off this week. So you can see the bond yields went up to 4.6 plus. They came down, but still they are high and they are on a upward trajectory. It has broken through the 20 EMA from the lower level higher, and the problem comes if the hike is like this kind of things, steep hike in very short duration. Right now it is going up smoothly, so right now there is not much of panic, but people are concerned. And this is 10-year yield, 30-year yield has already reached 5%, so that is a concern. What has happened is Trump has threatened new tariffs on Apple and EU, and that led to that fall. And what his actions are telling is that trade war escalation can still come out of the blue anytime, any day. So what has happened is now the US dollar, after it was rising, had a major dip, and after going up or touching nearly 101 level, has come down to 99 level. And now it has broken that again, that 100 support. So let's see where it goes. Brent crude is at the similar level, down around 1.04%, basically on various higher production from the OPEC plus over a period of next few months now. Gold rebound, had a rebound. It was coming down to this trend line, bounced back from there, was up 4.86% this week, basically because of uncertainty due to, again, Trump's policies and other issues with China and rest of the world. Hence, the gold is now, again, money is going into gold after there was a news last week on settling of some trade tensions with trade issues with China. Copper flat, nothing much happened here. So the Chinese policy initiatives of spending more money, lower interest rates, and all people have seen through them. So they want to see actual action on ground and not go by the policy actions, because they are not making any impact on the metal prices. So don't get too excited if China cuts interest rates, etc., and start going long on metals. Now Bitcoin made a fresh high, went above this level of 110,000. And this is again because of the money is moving here because of uncertainty with rest of the financial assets. So people is considering this as a safe assets. Now S&P 500, it had gone above the 20 EMA but corrected around 2.61%. Let's see what happens. Monday the US markets are closed. Nasdaq, it had gone above this trend line, but it saw a decline of around 2.39%. So we'll see. And Dow also corrected around 2.47%. Now it has come down to that 50 EMA support. So if this breaks this, then we'll see again lower levels. Now India VIX last week. So if you see the 5 trading days, it is range bound, went up based on the US issues, and then has tried to come down, but it is not really falling down. It is around in that 16 to 18 range right now. So this has to fall down substantially for the volatility to reduce. Now Nifty, if you see here, this is a complete retracement of the complete fall. So it was trying to head to this 78.6% retracement, that is 25,300, but the move got halted last week, sold off. It tested the 50%, 61% retracement, and then bounced from there. So right now it is trying to consolidate and see where it goes from here. Depends on news flow and the money flow after this. Now, if you see on the daily chart, it's very simple. If you see here, it tested the 20 EMA here. So it tested the 20 EMA on Thursday, bounced from there. Then there was a positive move on Friday. So let's see what happens from here. But this move, now remember, see this chart, this move from April 7th to yesterday or Friday is directly or exactly similar. I'll show you the Reliance chart also to that. So it will mirror that. Now Nifty 1 hour, this is a Nifty 1 hour chart. If you see, it has taken support at where, because for a long time 24,500 had provided a decent support and there was a gap here. So it has filled that gap and taken support there and then bounced from there. So the first support remains this 24,500 level. And if it comes down to 24,500 level, that is the level to go long, not to go short, because it will take support here and then again bounce back. And this is what happened last week. Now Nifty Bank, if you see here, was generally flat. It seems to have made a double top at 56,000. So didn't move much here. Generally remained at the same level, but like Nifty, it didn't correct much. So if you see the daily chart, it is making a flag and pole pattern now. So, and it also took support at 20 EMA. So this 20 EMA is providing good support, this 54,500 odd level, that is providing a decent support here. So if this flag formation is confirmed, next move up would be the length of this flag. So this length of this flag is roughly around 6,000 points. So 6,000 from the base here, from 5,400, etc., will take it to 60,000. So that should be the next level of rally whenever it takes place, if this flag technical formation gets validated. Now, if you see here, HDFC Bank, similar chart, took support at 20 EMA, bounced up from there. So this 20 EMA becomes critical for it. The time it is above this 1880, that's okay. That should be your stop loss. Reliance, as I told you, similar chart, took support at 20 EMA, bounced back from there. So watch out for this 20 EMA level. That is roughly around 1400 level. If it breaks, that should be a stop loss. Midcaps corrected more last week, 1.71%. So left to see what happens. But this is basically based on results, news flows, etc., and sentiment. Small caps didn't fall much, but they made a kind of a doji last week. So it's undecided. It can go up, come down based on what happens. Now I'll cover two stocks. Why am I covering Dodla Dairy? It is more like a FMCG stock, but which is showing some growth. And that's why I'm covering this stock. Don't expect it to go up 30% tomorrow, but it will be consistent performer. Now, what happens here is management expects overall revenue growth to sustain at around mid-teen, that is 15%, supported by volume growth in double digits. It expects India's growth driven by consistent surge in value-added products, sales, and geographic expansion. So, value-added products are ghee, curd, etc., ice creams, etc., because they have higher margin. In VAP, it is witnessing strong sales of curd, ice cream, flavored milk, paneer, ghee, etc. VAP sales made up 34% of the overall revenue versus 28% in FY24. It plans to drive growth with further penetration in existing markets of Tamil Nadu, South India, and expansion in most states of North India, apart from Maharashtra, where the new plant is coming up. They are into Africa also. The growth might normalize from current elevated levels. Management expects high double-digit growth trajectory to continue here. It sees strong headroom for growth in current markets of Uganda and Kenya, and is not looking to enter other African countries at present. It took a price hike of 1.2 liter, rupees 1.2 per liter. Milk procurement costs have now come down. Now let's see their performance this quarter. They did a revenue growth around 15%. Q&Q, it was up 0.9%. It did, gross profit was up 13.5% because the gross margin dipped a bit. EBITDA was up around 10%. Again, EBITDA margins had dipped from Q4 last year. And PBT was up 26% because of higher volumes, and PAT was up 45%. So what happens here is, if you see here, Q1 is their best quarter for sale of curds, because obviously this is the summer season. So the sales vary but the curd sales are up 6.5% year on year, which is decent growth. VAP sales grew 28.2% year on year, with contribution at around 31% now of the overall revenue. Sales realization and procurement, so they are following a steady path, not much of a change, but spreads have come down a bit between the buying price and selling price. Sales grew 15.5% year on year, led by VAP, that is value added products, and Africa sales. Gross margins came down year on year. EBITDA margins also came down, as I showed you, and PAT grew around 26%. It currently trades at around 24.4x 1 year forward PE. The normal average PE is around 23. So if you see here, it is expecting around 14 odd % of revenue growth over the next 2 years. Operating margins are expected to improve. ROC is now reaching around that 20 odd level, and EPS is expected to be around 47.6, 53.9. So taking a mean of around 50, EPS is expected around this EPS is expected for next 2 years or so. Rest all parameters are decent, nothing much else to set up, and the valuations are coming down. So considering an EPS of around 50, this stock can easily trade, like I showed you, the average PE around 23. So it is right now at its fair value, which is 1150 odd for this stock. And there is a declining trend line, so it is now going above that. So any fall up to this declining trend line or the moving averages should be a opportunity to buy this stock for longest duration, because if you see here, the 20 EMA is now cutting the other moving averages from the bottom, and RSI is also decent, though it got sold off from the high it made with large volumes. So you have to buy this on dips only, but this is a decent stock to have. 15% revenue growth, 25% profit growth, and 15% ROE is a decent stock to hold. Can't lose money here. The other stock is AMI Organics. They are changing their name now shortly. They are focused on development and manufacturing of advanced pharmaceutical intermediates and specialty chemicals. It serves diverse end-use industries, including pharmaceuticals, cosmetics, fine chemicals, semiconductor, battery chemicals. It reported a strong Q4, driven by robust growth in its advanced intermediate segment, particularly the high-margin CDMO business, while specialty chemicals saw muted growth due to weak semiconductor-linked demand. Exports, but the semiconductor-linked demands are expected to improve from at least Q3 or Q4 of FY26, when the existing projects of various companies now which are setting up semiconductor plants in India will start functioning, especially the ones which Keynes, the others are setting up. Exports remained a key growth lever, offsetting domestic softness. Improved product mix, operational efficiencies, and efficient capacity utilization supported EBITDA margin expansion. Company is poised for strong growth, driven by expansion of CDMO business and ramp-up of commercial supply. Growth in generic intermediates will be supported by upcoming patent expirations, and specialty chemicals is expected to recover from H2 FY26, led by electrolyte additives and semiconductor demand. And electrolyte additives are basically required for companies which are into electric vehicle batteries, etc., lithium-ion batteries. So there again, the production is expected to start. A significant portion of FY26 capex, 130 crore, is allocated to electrolyte additive plant at Jhagadia site, where commercial production is expected to commence in H2 FY26. Exports are roughly 74% of the revenue, grew by 81%, and domestic 26% of the revenue declined by 19%. Now, if you see here, there are two basic business segments: advanced pharmaceutical intermediates for various things, intermediate across 17 therapeutic areas, and 95% chronic therapy focus. They are backwardly integrated to basic chemical level and market leader for key intermediates across the globe. Now, specialty chemicals, they're making various things for semiconductor chemicals, key starting materials for cosmetics, fine chemicals, and agrochemical companies, and electrolyte additives used in manufacturing cells for storage, energy storage devices. First company in India to manufacture electrolyte additives. Right till now, the electrolyte which we were trying to make was not that good, or we were importing the electrolyte from China. Now, let's see their earnings. So this quarter, they have done 37% year-on-year growth, earnings growth. And for the full year, the earnings have grown 40%. EBITDA margins have improved by 835 basis points. That is up 8% plus, and 514 basis points for the year, for the full year. EPS and adjusted profit have grown 151%, which is very strong. And for the full year, it has nearly doubled, little more than doubled, 130%. EPS has been around 19 rupees in FY25, which is very strong. So now if you see here, revenue breakup, advanced intermediates are 88% of the revenue and specialty chemicals are 12%. So they are saying that this should grow now in next year. Domestic export mix is again mostly it is exports and less is domestic. So domestic is expected to then grow subsequently. For future, they are expected to do around 25% revenue growth over the next 2 years or so. And EBITDA margins are expected to improve to roughly 25%. ROE is also improving to around 14-15%. And they are expected to do 220 crores of profit next year. So the EPS should be around 26.9 in FY26 and 34.6 in FY27. So taking a mean of around 30 rupees, it should easily trade at 40 times. So if you see here, the PE was in much higher territory earlier. So considering around 40 times, that means it can trade at around 1200. Let's see the chart. It posted good results, went up. Now it is consolidating. So I'm trying to looking to buy it at around these levels, 1100 or on a bad day or 1120 or so. So the fair value is around 1200, but they perform well because the business is good and they have got good growth. So they can easily go up from here. I have finished. We'll take questions now.